Hi. Uh, Today I wanted to share an experience I had last night with a friend. We were just out going for a walk with his little puppy, and during our conversations, he's somewhat of a finance economics guy, and he and I have talked about um, insurance and investments and all these kinds of things. And last night we got on the conversation of term insurance and whole life insurance, and consequently Dave Ramsey came up. It could have been anybody, Susie Orman, but it was Dave Ramsey. And Dave Ramsey has done some great things for people. Has helped out a lot of people getting out of debt, and help them discipline themselves to do that. And that does take discipline. Anything worthwhile takes discipline, in my opinion. But anyway, it came around to that, and I, the only thing I think of when I think of Dave Ramsey is it's great that he's doing what he's doing, but then on the side, he likes to talk about whole life is like not a good thing. And that's where, there's a disagreement in that he doesn't really understand whole life dividend paying life insurance with a mutual insurance company. If he did, I think he would completely change his language, and maybe it would be difficult for him because his audience, he's been saying it for so long, but he doesn't really seem to understand it. And you can anyway, that's another time for that. But anyway, we started talking about term insurance, and that we know from on the surface, the general public looks at term against whole life and thinks, wow, whole life is so much more expensive. But in fact, it isn't. It is actually term insurance. Well, let's just give a little history. Term insurance was created long ago, Egyptian times. But let's not go back that far. Let's just go to Columbus. When Columbus was sailing the world and discovering different places, such as where we live now here, somebody was underwriting that trip. Somebody was ensuring that he would get from here to there and back with their investment. And it was a contract, somebody was basically underwriting it. And that would be a term policy, if you will. It's a term contract, which is what you sign. You have a contract with a particular insurance company when you sign on the dotted line for $12.95 for $250,000 worth of life insurance for 20 years. It's the same thing. It's term. It's just like your car insurance, it's basically term. When you stop paying, they stop covering. So it's the same, kind of the same deal. But anyway, so you take term. Here's a thought. I don't know how many of you have had term insurance before, but have you ever had term? Maybe you had a 10-year or 15 or 20, and let's just call it a 20. Just before the 20th year was over, maybe 6 months, maybe even a year before it's over, you'd get a letter in the mail, and it would be from the insurance company stating that next year or in the next 6 months, when this contract expires, year 21 is going to cost X amount of dollars. So say, for instance, you were paying $100 a month. If you want to maintain that same death benefit, that cost may now be $1,000 a month. And most people will say, well, I'm not paying that. What can I do? Well, there's really not a lot you can do. You could go out and say, okay, I want to buy another, say you were 20 when you started and now you're 40, and then you could go and buy another 20-year term. And it might be, let's just say for numbers sake, $200 or $300 a month. And you're like, oh, geez, that's a lot more, but it's not $1,000. So why don't I do that for another 20? You do it for another 20 when you're 59 and a half, almost 60, you get another letter. And now instead of being $200 or $300, it's going to be $2,000 a month for that same coverage. And most people will either lower the death benefit or drop it completely. And now there may be some illness, some chronic thing going on, and you can't actually qualify for any new insurance. And so you're locked out. That's something to remember. So all of that money that you paid, the first 20, the second 20, all of that money could have gone into a whole life policy. Now, when you first started off, it wouldn't have been $100 a month. It might have been $400 or $500 a month. But it would have been like that for the next 20 years or the next 15. I mean, they can be designed all different kinds of ways. It could have been for the next 20 years, let's just say. You paid $500 a month, which was way more than $100 a month. 500, 400%. But at the end of the 20 years, you would have stopped paying and you would have kept that life insurance. It wouldn't have gone up. You wouldn't have gotten a letter. You had signed a contract 20 years before, or maybe even 40 years before, at a flat rate of, say, $500. And that is basically term insurance that they have put inside to pay out through your entire life. The cost doesn't change. So that first 20 years, when it went from 100 to 500 or 1,000, I said 1,000. That 1,000 would have, in whole life, would have covered you, So say you started paying that 1,000 and you did it for the next 20 years. And then if you had a term if you had a term policy at the end of that next 20 years, it would have ended again. All that money could have gone into a whole life policy, and you would have had some death benefit with a contract that would have been forever. You could have stopped paying and you would have had a whole life death benefit with cash value at some level, depending on how it was designed, and it would have lasted your whole life. I wish I had known that in the 70s when I first started buying life insurance, because I needed it. In the 70s and 80s, there was a huge push away from whole life into term, because there was this big push to, there was the phrase, buy term and invest the rest into the stock market, where you could get much bigger gains and all. But, some people would say, well, you can go to Las Vegas too and do the same thing. But anyway, I think you can get my point, that term is just whole life, or whole life is term compressed into a certain amount of years that you pay a higher premium. And again, these can be completely designed any different way you want. I mean, there's lots of different ways you can design them, but it's got to be, in my opinion, it's got to be a whole life dividend paying insurance policy with a mutual insurance company. When you sign up with one of those mutual companies, you become an owner of the company. Therefore, they are under legal obligation to disperse their profits after all expenses, payroll and building rents and all that, to the owners. So depending on what your cash value is, that's what they pay the dividend against. So it's a great thing to think about, you know, because we think as people in the general population, we're all thinking, what is the difference between term and whole life is the cost. Well, no, it depends on your goal and what you want. And it also designed properly according to becoming your own banker or Nelson Nash Institute practitioners like myself. It can be used to create capital. Is where are you parking your cash? Most people are parking cash in a bank or in checkbooks and savings accounts, IRAs, CDs. These are all, you know, decent products, but if you parked it in a whole life dividend paying life insurance, I think you'd see the difference. Anyway, so that was our experience. We were talking about that, and I don't know that my friend had ever heard that before or understood it that way, but that's the actuaries the insurance company within the insurance companies are taking all this math and science and demographics and all kinds of stuff into creating a knowing of a population that they group together and pool together, and then say, out of these 100,000 or million people, X amount are going to die early, X amount are going to die late, and there's going to be a hump-like curve where most of them will die through here, you know. So anyway, that's what I thought I'd share today, and why you might want to consider this as opposed to term life insurance. All right. Thanks a lot. Have a great day. Thanks for your time.